I'm your host, Marian Walter, Head of Strategy here at Stake Rewards, and you're listening to the Staking Mondays podcast, where we provide weekly actionable insights to the staking industry for investors, professionals, and newcomers. My special guest this week is Rupert Barksfield from Amulet Protocol. Amulet is a decentralized risk protection protocol, short RPP, initially deployed on Solana. Amulet combines liquid staking SOL with risk underwriting for various DeFi applications. Since October 2021, Rupert has been project lead at Amulet Protocol. Next to this, he's a founder, investor, partner, advisor, and mentor at different companies. Notable are his activities as founding member of Cointelegraph Innovation Circle and his mentoring at Outlier Ventures. Today, we are going to talk about Amulet Protocol and how they want to offer simple, reliable risk cover for everyone in Web3. Rupert, welcome to the Staking Mondays. Great to have you on the show.
Thank you for having me.
So the big elephant in the room is obviously FTX, especially the fallout from its collapse that it had on the Solana ecosystem. So according to our Staking Rewards data, the total staked value of Solana went down from 15 billion US dollars to about 5 billion US dollars in the last 30 days. What's your take on this?
I think we need to check on the data. 15 billion that sounded like a lot, but I guess it's across the entire ecosystem. I mean, I really focus around the DeFi sector. I mean, we in DeFi we went off about 1.8, not too many months ago, billion, down to about 300 or 400 million. It was at its worst. It's climbed a little bit over the last week or so. But in short, I mean, look, the whole industry, and this is, let's take Solana and, FTX sort of out of this for a second. The whole industry is really hurting, right? Yeah, this is been a monumental event, and I hope that what happens after this, we're all able to learn. We're all able to learn from not, trusting too much in individuals or in companies that on the outside look flashy and nice and good, but actually on the inside are clearly very problematic, so to speak. I felt to that. I don't know how you fared, Mariam, but certainly I looked at FTX. I thought it was a bit of a shining example, in the industry, and I would often recommend using them. And it was just the glitz and the glamour that I was looking at. I really wasn't looking at the fundamentals underneath. Not that I really had a lot of access to it, but you would have hoped some of their investors might have done a little bit more due diligence and provided us with the evidence and the confidence that we needed in such a company.
Yeah, definitely. So I'm exactly in the same boat. I recommended FTX for somebody else as well as a good trading venue, and I still think that the matching engine was quite good. Trading was quite good on there, and yeah. So the only thing that gave a little bit of calming the nerves, so to say, is that Multicoin and all the other investors, they really didn't come to another conclusion, even potentially having the access to data. And then later on, you just see how the whole thing completely was so unprofessional. And the biggest thing in the end is Alameda wasn't even profitable in trading. So that's the strangest and biggest thing, and also the funniest thing afterwards to take away.
We thought we had seen probably some of the largest Ponzi schemes in history, Bernie Madoff, etc. But it's a speck in the ointment of what has been done and what may be done in the future. I don't think this will be the end. I think there will be other bigger things that happen in the future. But hopefully we can still at least learn from this. And actually, just as you touched on Multicoin and the other VCs from that, I've actually been really impressed by the response of a lot of the VCs in the industry who basically did hold up their hand and saying, look, we didn't do the DD like we should have, and this is a calculated risk from our end, and it hasn't made that much impact on our fund or whatever. That some have been really highly impacted, some some haven't. But there's been some that came in and held their hands up and said, look, we did an hour of DD on this, we put in X 100 mil, and it's made very little difference to our actual outcome. But then slightly beyond that, actually, just come back, bring focus back to the Solana ecosystem. More excitingly is how well DeFi and the community on Solana has bound together throughout this process. It's been long thought that FTX and Solana are just hand in glove, and actually this has been able to show the world that that's not the case. They are entirely independent of each other. And just looking at the price of Sol and how well it's been rallying over the past few weeks, and holding its own against some really fierce FUD and sell pressure out there, it's done really well. And then if you look at the actual protocols themselves, very quickly forking and making difference with the Serum protocol. As soon as that was found out to be exploited, the community came together, they forked it, they made a new one, they made it better, and now that's out there for everybody to use.
Yeah, so two things to that. First, of course, would be how does it affect Amulet Protocol? And I think you already answered my question. My second question is, how do you think the ecosystem will develop forward from here? So you see that the big patron is out of the way, and now the prodigies, they start walking on their own, right?
Yeah, I mean, so from our point of view, look, we've been a multi-chain solution since day one. And whilst we took the decision to develop out on Solana first, our system has always been designed to bring in other chains and operate in that fashion. Because, we're here for the whole of Web3. We're not just here for one specific ecosystem. And I think if we were, we'd probably be in more of a fearful state now than we are. We're actually as a business, we're pretty comfortable. We got a good operating system, and we're now just deploying onto our additional chains in order to maximize the amount of coverage we give. So in short term, there has obviously been an impact. We launched in October. And we would have preferred for the rest of the year to have been all rosy, but these things happen in crypto, and we're in a team that have run through several bear markets already. So we were expecting a bit of a crash to happen. We just weren't expecting it to be as severe. But as far as we're concerned as a business, we're moving forward as normal. It obviously isn't normal as a market environment out there, but we were designed at the start to deal with this.
Got it. So you already mentioned it. You went live in October, so that's roughly 1.5, 2 months ago. Give us a brief explainer about Amulet Protocol. What is it and what does it do?
Sure. So in short, we're a cover protocol, which means that we provide cover policies for protecting the loss of potential crypto while you're staking it on protocols that we cover. So right now, those protocols are Orca, Radium, Solend, Mango, 2 or 3 others that are in there that I'm just off the top of my head. But if you head over to amulet.org, you can have a look at that. And with the protocol, you're able to take up cover for whenever you stake on those protocols. So let's say you staked $1,000, you come to our platform and take out a policy for $1,000. And if the smart contracts were exploited and your capital was stolen, then you would be covered entirely for that. And the way in which we cover that capital and we underwrite it is with the other side of the platform, staking. So we run a liquid stake asset, which is AMT Sol. So you come stake Sol onto our protocol that generates AMT Sol, and you can stake that into AUWT, which is our core underwriting token. And that underwriting token gives you exposure to those insurance policies or cover policies. And it means you generate yield from those policies, as well as generating yield from the staking as well. So Typically, our yield looks between sort of 14 to 20%. But it all really depends on how many policies we're selling on the other side.
Is
And
this
one,
just the policy yield or both staking and policy yield?
that's staking plus
Mhm.
policy. So yeah, the normal staking rewards are like any other sort of Solana validator. And it's actually important to note that in the not too distant future, we'll also be accepting other liquid state assets into our AUWT token. So those users can also benefit in those rewards. But the important thing to bear in mind, and the way that Amulet is designed, is so that when you're staking inside the protocol, you're risking your yield and not dependent on your full staked asset. Because the way that the risk engine is designed and the way that we sell our policies on the other side is all in line to make sure that if you're making 20% yield on your, let's say $100, so you put $100 in, you make $20 worth of yield, we risk on the sales side $20 and not the $120.
So it's only the interest basically that's at stake and not the principal, which
Correct.
reduces
Yeah,
the
yeah.
risk for those that assume the risk for the one
What
that's pushing the risk away.
exactly that. And again, further to what we've designed is the yield could be an awful lot higher than that, but we've specifically we report those numbers because we're expecting claims to come in. We're expecting be able to be one or two hacks. So we put in these barriers, these breakpoints between the claims and the staked assets, and those barriers are principally the yield from the stake validator, the yield from the insurance policies themselves, and there's one third pool as well, which is yield that comes from our capital acceleration program, which is another product we haven't turned on yet, but it enables platforms like Radium to put tokens into our system, which we then distribute to stakers. If stakers specifically want to back the insurance policies on, say, Radium, and benefit from those additional rewards. But that's a product that's going to be coming out probably more around Q1, Q2 next year.
Got it. Which risks do you cover?
So right now we do smart contract risk. That's our core product. In the not too distant future, we'll be launching a stablecoin DPIG product, and there's some other nice products as well coming in 2023. Slashing risk being the most interesting one for the people in staking, and that will be looking at insuring firms that have specific issues around or concerns around slashing, and that probably won't be in the Solana ecosystem, because if you know much about the Solana staking, they haven't actually turned on their slashing mechanisms just yet.
What was the timeline again? Sorry, for the slash.
We'll be doing that in early 2023.
Got it.
And the other products that we're looking at that people have asked us for is obviously exchange risk and custodian risk. Those are two big products that people have asked us for. We've designed them out, but it's all about what's beautiful about DeFi, and also our biggest Achilles heel, is that everything is totally transparent. You can see exactly how much capital we have staked and exactly how many insurance policies we've sold, because it's all on chain, right? Nothing is hidden. The downside to this, the level of transparency, is that we literally cannot sell the insurance policies unless we have the capital to support those insurance policies. So we have to be very staggered and staged with our policies that we come out with, so that we're then able to make sure that we have the underwriting capital, and everybody can see that underwriting capital is there in order to sell the actual policy.
Could you run us briefly through the maths behind it? So, because you need some actuarial experience there to really bind the risks that you assume to the backing that you have, claims that you pay out, and so on? What's like, is it possible to give us a little bit of flavor of the math behind it?
Yeah, I'll give you an example of it, but I want to be clear about my example up front. This is not an exact representation of how we do it, because our system is constantly in flux. It's designed as an algorithm to bend and flex, so depending on how many policies we've got on this side, how much capital we've got on this side, and it's constantly rebalancing. But the general principle around insurance works insofar that if you have $100 million of staking capital on one side, and let's say you insured $1 billion worth of capital on the other side, now initially you would go, well, how does that work? Because you've got $1 billion worth of policy over here and only $100 million to cover it. If that went pop, it wouldn't cover it. These guys wouldn't be made whole. Well, what you do is you don't put that all on one protocol. You put it on 30, 40, 50, 60 different protocols. And so you build up the your kind of spread of risk, and the likelihood of them all being attacked or exploited all on the same day is very, very small. So you're creating a large amount of yield from all of the policies. So $1 billion worth of policies would generate us, between $50 and $60 million worth of yield on a $100 million worth of actual capital that's been put down in order to insure it. So if you've got that $50 to $60 million, that's obviously 50 to 60% in terms of rewards coming back. Then we calculated in like how many we're expecting to go bump and how many are expected to actually have claims, and that'll come out of the kind of top portion of the rewards that are coming back. So let's say it's generating that 50 to 60 million dollars, but the system is designed then to take 20 to 30 million dollars worth of hits before impacting anything else further down the line.
So the basic idea is uncorrelated risk, right? As soon as you diversify, the uncorrelated risk gets diversified away. But what I'm asking myself is, in traditional insurance, you have tons of data, right? Ranging back, I don't know, 50 years, 70 years. All this long time series of data is not available for DeFi. So how do you come up with the actual probability distributions and all the statistical states, so to say, to make these calculations? I assume there are many things that we haven't uncovered yet from an actuarial side.
Yes and no. So one of so we could put in the category of cyber risk insurance. We are in that kind of big, very broad section, and cyber is actually in a very, very similar area. It doesn't have this huge amount of data going way, way back, and equally the exploits are very, very different kind of going forward. And so as an actuary, how would you put a premium price on insuring Google for cyber risk? I mean, it's almost an impossible task, but you've still got to do it because you've got a customer here that demands a product. So the way in which you do it is you build out a lot of space and theory around each potential area of risk. Now, the difference with what we've got on in DeFi is actually everything's been recorded. We know exactly how every single exploit has happened, and there's been quite a lot of exploits. I mean, last year about $12 billion was stolen. This year we've had, I don't know the exact figure off the top of my head, but probably around $3, $4, $5 billion already. Albeit we're almost at the end of the year now, but there were some mega exploits this year. I mean, we had the Ronin hack, which is a smart contract exploit, that was about 600 million. There have been other types of exploits which have been a bit more newer this year. So we looked at something like the financial exploit on Mango with Avi, and what he was able to achieve there, and that was financial, but it was also DAO expletive, because he was able to manipulate how the DAO operated in that. exploit. But again, all of these are tracked, and we understand exactly how any particular exploit happens. So with something like smart contract risk, we actually really do have quite a lot of data around that, and we really understand, that particular product. With stable coins, again, they've been around for a long time. We know exactly how they depeg or when they depeg. We know the kind of the operation risk, and then it's about building buffers around that. So there's no kind of two ways around it. The sort of on-chain insurance is quite expensive for what it is, but over time, as we get more data, it will go down. And also, I hope really that the industry is going to get a little bit more safer all around as well.
So that's super interesting and also fascinating, I think, for people coming from traditional insurance, that actually you have much better database to draw from to calculate your risk and the premium and so on. And as you said, over time, I think the most expensive or the most dangerous risk are the unknown unknowns, right? And over time, we would assume those to go down. So super interesting. But last question on the super technical details. You've baked all of this actuarial science into code that runs and automates updates automatically. Is that correct?
I won't sugarcoat it. It's not 100% is in there, but the vast majority is all built into the system. We have a team that have come from insurance. They've worked on other DeFi insurance protocols as well. We really understand, the pitfalls with inside DeFi insurance and cover, as well as the pitfalls within the traditional insurance sector, and what we're trying to achieve as a vision as a business overall. So we've been very lucky that we've got a lot of the best brains in the industry that have baked this into the actual the core of our DApp. But there are areas that have to be done outside that. So when you look at something like a claim that comes in, we've built out all of the claim submission and the majority of the claims processing engine, but there are elements that still need to be looked by human eyes. So as we're on the subject, with a smart contract risk claim, it gets submitted into the system. We may ask that wallet for more data, a bit more evidence for them to supply, and our team will make an assessment on it. Our community will make an assessment of it. If we're both in agreement, we'll pay out. If we're both in disagreement, it doesn't get paid out. And if there's an imbalance of agreement, then it goes to a third-party DAO to come in and make the final decision for us. It acts as a jury on our decision-making process. So we think that this is a better way of operating a claims process, and typically it works very, very quickly. So we've had a few claims come in on different policies that we've had. All of them so far have been rejected, just on the fact that they weren't proper claims and the evidence wasn't submitted, and there wasn't actually a smart contract exploit in the first place. But there have been many other examples of other protocols. People like Insurace actually is a good example, where they assessed claims for the UST DPEG and ended up paying out a substantial amount, and doing it in a very, very quick turnaround time. I think they went from DPEG to payout with about 3 weeks, which, given that it was about $12.5 million that they paid out, it's an impressive feat to see.
So you already mentioned other DeFi insurance protocols, Nexus Mutual, Insurace, or Opium. First of all, could you give us a map over all the players in the field? And then second question will be like the differences. How do you differ from the others?
Well, I'm not going to go through all of them. There's about 20 or so that are in pure DeFi, and then beyond that, there's about 4 or 5 that I would say are sort of on the fringes of DeFi, providing cover, but they're not really a decentralized protocol themselves. They are a traditional insurance firm that will provide cover for the sector. There is when you look at the industry, the Nexus Mutual is a grandfather. They're really the ones who started us, but they only started 3 years ago, right? So insurance is new. The whole DeFi sector is very, very new. You know, we are finding our feet to really help and grow this industry. And to be honest, when I look at my competitors in the industry, we really don't see people as competitors at this stage, because we're all very nascent. We're all very new in this business, and we've got a huge job to do. So if you look at the traditional financial services sector, insurance equates to about 25% or so of the of all capital running through the financial services sector, which is trillions of dollars. If you look at DeFi right now, insurance equates to, well, a few weeks ago it was about 0.5%. I dare say right now it's probably about 0.3% of the entire ecosystem. And so we have to push that figure up to at least 25%. In fact, my personal goal is to push it up to about 80% in terms of assets covered in DeFi. Now, in order to do that, we need a lot of people to cover that space, and to make sure that it is safe for everybody coming into the industry. And the reason why it needs to be there is that without coverage, we're not going to be getting the institutional players to come into the space. If we don't get the institutional players to come into the space, we're certainly not going to be able to get the average retail person. And I'm not talking about those who have already joined crypto, the sort of 1, 2, 3% of the world that are now using crypto. I'm talking about the other 50, the 80, the 90% of people in the world using crypto, because they are going to take their signals from their bank or their trusted mobile wallet or whomever it is, and those people are going to be providing the insurance, hopefully with players like ourselves and others as the industry grows.
I think it's a recurring theme that in the beginning there is not so much competition as rather cooperation, because everything is so new. So many things need to be developed, to be covered, to be discovered, and everyone is learning from each other. And I think this is a part of the culture and the ethos that people also that draws people into crypto, because it's not yet as mature where there's pure competition and everything is standardized and goes through, I don't know, economies of scale and so on. So this is part of what makes crypto so interesting right now. And yeah,
100%.
definitely. Insurance is one of the cornerstones to bring Web3 to 1 billion people, because you need institutions for that, and they won't touch anything if they can't manage their risk properly.
Yeah. And so, when I look at our typical customers, we deliver the product to anybody who wants to use the protocol, because it is DeFi and anybody can interact. But really, the main drivers of revenue are going to be our major institutional plays. So one of our customers is another DeFi protocol. They are working with a very, very large, well-known hedge fund who want to deploy about $100 million into them. This hedge fund has said, okay, everything checks out, your technical requirements all check out. But in order for us to be able to do this with our customers' funds, you guys need to get smart contract risk insurance. And so that's why they come to us and pick us up, and we're there to provide that to them and enable that flow of capital. And that flow of capital then gets deployed into several other DeFi protocols. So it really does help the whole industry.
When did you see personally for Amulet Protocol the first evaluation from the market, like real demand that you were able to cover?
The biggest change for us personally was probably around April this year. So by April, we came out in terms of, we were working in stealth up until that point, and we came out. We said we were operating on Solana, and we're going to be the first DeFi insurance protocol on Solana. This is what we're doing, and the amount of inbound inquiries that we had that week was just insane. Like, I mean, virtually the entire ecosystem came out and said, we really need you, like, come and help us. We want coverage here on this, on that. And honestly, a little bit overwhelming. You know, for a startup, there's only so much you can do, and there's only so many products you can work on at any one time. And apart from anything, we hadn't even released our product by that stage. So that was the first indicator. And then it was when we released the platform in October as well. Up until the FTX actions, and between then and now, we stopped sales for a short period just for the market to stabilize and understand where things were going. Today, actually, we're turning our sales engine back on. I'm very happy to say, but the up until that point a couple of weeks ago, we'd sold 631 policies. Now, that might not sound like a huge figure, but when you put it into context, you look at somebody like Nexus Mutual or Insurace, they've sold about 7,000 or so policies in over 3 years. So we just done just under 10% in 4 weeks. And so that was a huge, indicator to me to say, yeah, there is demand. There is massive demand on our for our product inside the ecosystem. People want it, and we could be talking, thousands, tens of thousands of dollars worth of coverage, as well as hundreds of dollars. And we're the guys that are able to do that. And that's actually, we're able to provide hundreds of dollars worth of policy because of the Solana ecosystem. Because on Ethereum, as you're probably well aware, we just can provide that with the gas fees, etc.
How does the sales process look like? Because I presume you are the project is set up as a decentralized entity,
Yep.
and so how does this go together with, I don't know, sales teams, or is this automated? How does the sales process look like?
So right now it's very much the founding team that manage the kind of the sales process. And when we're talking to outside parties and protocols and that sort of stuff. But as an individual, if you wanted to get a protocol that's coverage on a protocol that we've already listed, that's very easy. You go straight onto the Amulet website, you pick the protocol that you want, you put in how much coverage you want. It'll give you a price, you pay the fee, and you have coverage from that date going forward. And obviously the future for us is actually to make that even easier. We want to streamline this process. We want to integrate with Radium, with Binance, with anywhere you're actually going to be purchasing or staking your assets and wanting to buy cover at point of purchase. You'll be able to tick a box and just go tick. Then I'm covered for that. Or potentially you'll be using institutions that have already got total blanket coverage for everybody using them, and we can provide that directly to them too.
So it's all automated at the point of sale.
That's the future. Full automation. Yeah, anything we can automate, we will automate. And I just love that to apply to me and my life too.
What are the challenges that you and other existing decentralized risk protection protocols face and have?
So the biggest challenge to all of us is capacity. Always around capacity. So it's difficult, or has been more difficult. There's a lot more interest nowadays, but it's difficult to excite people around staking in a DeFi insurance protocol, and that comes down to the fact that they think, well, there's huge risk. I put my money in. I'm just risking it against that protocol being, exploited, and all my money goes. And that has happened before on other older protocols, and which are no longer in existence because the way that they were designed was fundamentally flawed. So trying to re-educate and re-engineer and say, look, we're designed an entirely different way that protects your staked assets is actually a very difficult thing for us to do. So there's a big education part in order to drive capacity. And when we drive capacity, we're able to sell more and more and more policies. And that on our side is the thing that we definitely do not have the issue with. We were consistently sold out on all products day after day after day, right up until FTX.
So wait, capacity is money backing claims. That's the bottleneck.
Yeah, it's staking in order to provide underwriting capacity. Yeah.
And this capacity is also capacity for you, or it's not a constraint for you?
Oh, that's the biggest constraint for us as well
Mm.
as everybody else in the industry. But like I said, that conversation is getting easier. Yeah, especially when people really look at the model and they recognize, oh, there is protection. There is a risk engine in here. It's well designed. It's well thought out, and actually the relative risk to my capital is pretty small. And so when you compare it to something like doing yield farming, where you are putting it back in the loan machine, 1, 2, 3, 4, 5, 10 times, whatever it is, and the risk is going exponentially higher, and you're still only yielding maybe 17%, then actually doing something like us, where you just one click and you're done, it's a lot easier, it's a lot safer, it's a lot better thought through, and there's less things to be concerned about along the way.
What's the size of the market? Could you give us like the rough calculations that you and the team have made?
It's vast because as we look at the market, we're obviously $1 trillion market at this stage. We're looking for that to expand at least 5 or 10x over the next 5 to 10 years. And as we look at it right now, we have billions of dollars worth of cover that people are demanding for insurance for. And we as a little company just have to try and find the state capital to provide that coverage. So, when we look at more exacting figures, size of the market right now of crypto insurance or DeFi insurance in terms of assets that are insured is about 500 million. My expectation is to push that all the way towards the 2, 3, $4 trillion mark.
Mm. Because of growth of the overall underlying market.
Growth in the underlying market, as well as growth of the requirement to insure crypto around the market. In order to get that institutional growth, which spurs the retail growth, as we kind of mentioned before, that's critical in order to drive the overall market growth.
Right. Amulet is creating the protocol controlled reserves (PRC) approach, in which Amulet will build up reserves and introduce a claim structure involving a unique yield back claim (YBC) method. Can you give us insights to your protocol design?
Yeah, so this is coming back to the original structure I was talking about. So that kind of specialized risk engine, and that's all built into the PCR. So the PCR is core to everything that Amulet does. And so you've got the staking rewards first. That generates 6, 7, 8% if we're lucky. And that builds into the first pool of reserves between a claim and a potential staked assets. The second pool is the premiums that come in out of the insurance policies that we build, and the third pool is the assets we hold from the capital acceleration program. And as I touched on before, the capital acceleration program is there to help protocols encourage users to increase the amount of capacity for their given insurance policy. And why would they want to do that? Is because they're on the phone with one of these very large hedge funds or institutions who want to deposit a huge amount of capital into their protocol. So they need to get the capacity of that insurance policy up before those big guys can come in and take the policy and deposit into their protocol as well.
Mm. And so from listeners from Staking Rewards side, how does staking come in there? Is basically staking is the mechanism to build up the reserves that are backing the claims for the policies sold. And people are able to earn rewards from staking with Amulet Protocol. Is that right?
Correct, 100%. Yeah. So staking in Amulet is a very safe way to generate a very high yield, and you do so by staking Sol right now into Amulet Protocol. That Sol can then be staked into, or that creates our liquid staking token AMT Sol, which can be staked into AUWT, our underwriting token. And if you want to go the next stage up from that, you can also stake AUWT into individual protocols and earn even higher rewards. But you are also increasing your risk. So the base level, just come in, stake Sol. In fact, on the front page, you can stake Sol straight into AUWT and forget about everything else, and you'll get a really healthy yield on that capacity. And the risk of that capacity, the core risk, is about risking your yield and not your initial principal. So that's how the whole system's designed, is in order to put all of the risk that we're putting on the claims into that yield.
So it's like 3 stages of staking, all with increasing risk profile.
Correct.
How do you decide which protocols to cover, to offer cover for, and especially how do you decide on where do you want to expand next, like even across Sol
Yep.
onto other ecosystems?
So I'll answer in 2 different questions. How do we decide protocols? It's a very good question. It again comes very heavily into our risk assessment system. So we start talking with the protocol initially. We send them over our risk assessment form, which they have to fill out. That form principally is looking for 3 core things. It's looking for how much TVL they've got right now. It's looking for the and how quickly that was built up, which is also quite key to our risk assessment. We're also looking at who's audited them and how those audits have been done, and if there's been any changes to the code subsequent to that audit. We're also looking for a CER rating. So a CER rating is something developed by Hacken and gives a generic rating to the risk or safety of a project that we're looking for, and so we get them to sign up for that as well. And if they get a high enough CER rating, they've got a credible audit, they've got a high enough TVL, and critically, our tech team has also signed off on their smart contracts, and this is specifically looking at smart contract risk. We are then able to provide an insurance policy and work out what the premium will be. The higher the premium, the higher the risk in our view. So, for example, multiple nested or triggered smart contracts would be a higher risk than something that's very simple and a very easy to understand smart contract. And so that's our primary way of assessing a protocol. In terms of which protocols we take on, it's somewhat demand led, and that demand is led partly by our community, but also partly by who's coming to us and asking for cover. The primary amount of demand is really led by those people coming to us saying, we need coverage. We have this customer here who wants to deposit quite a lot of capital, and that obviously helps our stakers, it helps our community, it helps them, it helps the Solana ecosystem, and so that's why we go where the demand is.
And all of the assessments, and especially the results of these assessments, are they visible to the entire market on chain, or is there a part of it left just towards the core team?
Yeah, so right now there's some elements that are just in the core team, but we are actually going to make those public on in the protocol. It's been asked for us to put our risk assessment process into each individual policy. That's going to be coming as well. So in short, yes, it's all going to be available right now. They're hidden just because we haven't developed that out on the platform, but everybody has to go through that process, and we have to be very clear about, we cannot take on anybody. It is damaging to us and the entire ecosystem if we are to take on somebody that could be exploited.
Got it. And for our live listeners, if you have questions for Rupert, make sure to drop them in the comment section below, and I will pick them up. One question that I was thinking about is, how do traditional finance people look to you? I mean, you will have certainly some exchange there, and those are huge mammoths dominating the whole of the traditional finance scene, so to say. What's the flavor of the conversations with them?
It's really interesting, actually. So we've spoken with a number of different firms in the traditional insurance sector. They are very interested in what we are doing in the DeFi sector. They don't really understand it for the most part, and there's levels of knowledge. So there's a huge firm, probably I think about the third largest in the world. We were talking to. They invited us over to San Francisco and talked to their entire management team. And so we went to talk to them about what's happening in Web3 in terms of some of the risks that we're seeing and how we are approaching them. And really, I think what their interest is right now is just trying to understand, because there are people in that room that hadn't bought a single bit of crypto in their entire lives. So that you take insurance and you take the financial sector, and you can. A lot of people have definitely heard of crypto, and I would argue in the financial sector, probably quite a lot have bought some right now. But the subsect of insurance within inside that, you're talking to a group of people who are very, very risk averse, and so it is a very slow, but it's a healthy process to go through. And so we've been building those links since day one, each different firm has a different understanding and different take on them, and we are starting to see them take those first steps into crypto and into DeFi insurance as well. In particular, I believe Munich Re has just done a deal with a product called Names, NAYMES. And they are another DeFi insurance protocol. They operate in a slightly different way in terms of that they have a kind of risk marketplace. But they're able to, Munich Re have reinsured them so that if they have a large claim that clears out all of their capital, then Munich then takes on the risk thereon as well. So they are taking those steps. At the moment, it's a very high cost, and it's it's very small amount of capital that we're talking about in comparison to what the actual size of the market is. But it's a good sign. It's a good indication, and I think it's going to transform the industry, in the future. They can't avoid it, but our focus and our opportunity, obviously, is to really capture that market and own it, and that's really what Amulet is focused on.
I think it's super interesting to think about it that in traditional finance, if you could look directly into the mathematical heart of the big insurers, it's crazy. Everyone would want to copy them and would gain so much insight. And actually, you have the situation in DeFi that you can almost see everything. So potentially, there's nothing hindering these people to just come in, copy the thing, and ensure everything. But actually, there is a huge barrier to that. This is just a knowledge gap, right? And so that explains also why they're very interested to hear information from you. And I also think at that stage, there cannot be a competition, something like that. It's really cooperative.
That's exactly it, and that's what our sort of focus is as a business. We're very focused about being a massive thorn in the industry, so that we're able to have so much industry coverage over the next 5-10 years that actually it would be impossible for a traditional insurer to come into the space without having to partner or without having to do something with us, and that's almost core to our strategy.
How is Amulet Protocol set up legally?
So we are a DAO. We operate entirely in the as a decentralized or autonomous organization. We did raise under a BVI entity, which is still in existence, but that will be obviously disbanded at a set point in time when we go fully autonomous.
Is MEV also part of your strategy in a way? Do you plan to incorporate MEV to your Sol staking services? And
So
if so, where would these additional rewards go?
that's a very, very good question. In short, we haven't integrated anything just yet. We are very interested in what the whole kind of MEV movement is doing. Our interest is probably more around what the risks are with what you're trying to do with the MEV, and so we're trying to understand that better so that we can design a product around it. It's a big topic on everybody's lips right now. And so, it would be our focus to look at the risk side first over the staking side. Now, I caveat that because if we can employ it at a low enough risk level within our own staking mechanism, we will, and the rewards for that will obviously go into the same pools that the capital from the premiums and from the staking already goes into. So essentially, it goes back to the staker.
Got it. I'm going to turn to the community questions now and leave 2 conclusion questions to after that. So Mason is asking, how relevant do you think DeFi coverage is in a bear market?
It's a very good question. So I think it's actually more relevant now than it is typically, or at least it seems more relevant now to the individuals that are buying it than the than in a bull market. So we started as a project back in October, November of last year, so in 2021, and trying to get people interested in DeFi when it's at the insurance, when the market's at the top, was actually much more complicated because people were saying, well, look, you're getting massive yields from DeFi. You're only going to be generating 14, 20%. How on earth is that interesting to somebody in this marketplace? And we just had to really rebut that back and say, look, the yields that you're getting on a lot of these protocols are inflated and they're not real. They can't possibly operate for very much longer. And then we saw things like the crash of Luna and UST and Anchor and all of these issues that happened in Q1, Q2, and a lot of those other protocols going bump and rug pulls happening left, right, and center. It was inevitable. From our point of view, it's totally inevitable. We saw it happening a long way out. Thankfully, our investors who came in by that stage also saw it as inevitable, and so they were backing us on the basis that, okay, insurance is a good product through the bear market. And so that's the thing. How relevant is it in a bear market? I think it's incredibly relevant in any market fashion, but we get much more attention in a bear market because we are there to protect people, and a lot of people have just been burnt. And as much as I hate being the ones who say, I told you so, or that, we need more of this when people are hurting, it is unfortunately inevitable that we do need more of this. It's not the only thing we need, but it's a massive component.
Definitely. The whole crypto market tends to be super pro-cyclical, so it's great to have discovered at least one subsector that is anti-cyclical, so to say. So that's good to have with insurance.
We would like to be consistent, actually, is where we would like to be. Just consistently plodding along, doing great rewards, doing the same sort of rewards that any other insurance company has been doing for decades and decades and decades, or hundreds of years, actually. But just average people have not been able to access because they've not had, a $10 million mansion that they can put on the line for Lloyd's of London and become a name of London. These kind of old school barriers to entry for people. That's one of the things that our mission is to break down. But then it's also about making sure that everybody's safe.
From Ona Hack, We got the question, are you planning to move to another ecosystem due to the current situation with Solana?
So I mentioned this right up front. We are a multi-chain solution anyway, so we're not going to be moving, so to speak, anywhere. But we will be absolutely adding additional chains to our system, and integrating that with the overall Amulet protocol. But in short, no, we're not moving anywhere. And I'm actually pretty bullish on Solana. I'm also pretty bullish that the whole ecosystem will come back pretty strong in the next bull cycle. I have been wrong before about a lot of these things. I've said it publicly that about things that I've been wrong about. But you know, looking at how well the DeFi ecosystem is doing, looking at how well the Solana price has been doing in the midst of all of this FUD, I think it's doing remarkably well personally.
Got it. Then another question, a little bit on a lighter note, from Mason. Rupert, you have a cool beard, says the entire Russian, Ukrainian, and Belarusian community. How long did it take you to grow it?
Not that long, actually. I mean, I've had it now for probably 8 months or so. But it only takes about 2 or 3 months to get to this level. I know I've always got a beard. If you go back to the other shots of me at the beginning of Amulet, it's just shorter, and it might be coming off. I don't know if I don't know if that's a good thing or a bad thing, but
Maybe we need a community vote on that.
Yeah, we'll put that to community. That's a great point, actually. Thanks, Mason. I'll pick that up with Mackie later.
Great. Maria is also asking or saying, we have a very friendly community. Thanks to the team for this, for the games, and the additional opportunity to get points. What are your plans for the ambassador program? What other interesting things do you have in store for the community? I don't know if it was on Amulet that I saw that you had a chess tournament.
Yeah. We do. We do chess. We do weekly games, of which I do my best to join. Although it's been a few weeks, so again, sorry from my perspective. But Pinto Pallado is our king when he comes to organising these things, and he's got a great team around him, including Mason, who's been commenting. But in terms of what's happening inside the Amulet community. So if you haven't joined, if you're watching this and you're going, what the fuck are you talking about? Like, go onto amulet.org, click on the Discord link, and do join in the community. It's great fun. We put a lot of effort into it because it's core to everything that we do, and there's a lot of rewards that you can gain, in particular through our Ammu app. Now, the big thing with the Ammu app is there's a huge new release coming, and that's going to be on the other side of Christmas. I think it's going to be nearer to March, if I'm being honest, and I hope I'm not spoiling anybody's thunder by talking about this now. I'm just realizing as I'm halfway through the sentence. But there's a huge new update coming, and with that update, there's a lot more actions for the whole community, and it's a lot more integrated with everything that we're doing. So hold out for that. Obviously, I do my AMAs as much as possible. I try and join the AMAs every other Tuesday. I think we've got one last one before Christmas, maybe, and then we're going to take a little bit of time off to spend with our families and give them a hug, especially after FTX and everything else that's happened this year. Stay tuned inside the community. That's the best place for updates. And Pinto Pallado on the community is your man for any questions further to what I haven't been able to answer today.
This sounds really great. I think I need to join for one of the chess tournaments.
No, absolutely. It's great fun. And you're up against some pretty good opponents. It's the poker I like doing.
Do you know their scoring? What they have?
I don't know, but certainly you've got a large Russian and Ukrainian section, and as you can imagine, they're pretty good on their chess.
Got it, right. Maybe give us again, I mean, in the beginning you already plugged it, but give us again an overview over your roadmap, let's say over the next 12 months or 24 months.
Okay, so core that's happening is we'll be adding in some additional change and coverage. And then we've got a whole bunch of different products that are coming out, including stablecoin DPEG, slashing cover, exchange risk, custodian risk, NFT risk, GameFi risk. There's loads and loads coming. And really, for when I look towards the end of that 24 months, it's really about growth, 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 growth. So all of my focus is entirely around how do we grow Amulet to the next stage? How do we get from the small amount of TVL we have now up to the next value? Where do we get to 250 mil? Where do we get to 1 billion? When do we get to those greater figures in terms of staking? And then on the other side, how do I bring in the bigger policies to make sure that we're providing the yields back to those staking? Because you've always got that two-sided issue. You have too much capital on one side, your yields are going to be very much smaller. You've got too much insurance, you can't sell if you've got too little capital on this side. And that's the position that we're in right now. We've always got far too much demand and far too little capital on the platform. So that's my focus over the next 24 months. Obviously, it's not just about me; it's a team effort, and that's what we're all heading towards.
Speaking of the team, are you hiring? And if so, what profiles are you looking for?
Are you looking for a job, Marion? Is this the right?
I ask that to all guests on the show.
So at this very moment in time, we're not hiring, but we're always interested in people who are excited about our mission and people who are excited about what we want to achieve. And if you have any sort of applicable skill set, message us. We're available on Discord. We're available on Telegram. Always send me or any other the rest of the team a message saying, I really want to work for you and this is what I can do. I think I can make a big impact, and we can always try something else. We want to work with people that want to work for us. So at the moment, there's no specific role that we're looking for, but if you are a developer, if you're an actuary, if you are a business development executive, and you reckon you've got the good skills to help us, message us. We'll always take a look.
Perfect. And closing off with one or two questions towards you more personally. First thing is about books. What are your favorites and what are you reading right now?
Probably one of my favorites is 0 to 1, which oh god, the writer has just gone out of my head. Peter Thiel, I think, 0 to 1. I may have to look that one up. But that was a great book in terms of like understanding like when you are at a certain point with a startup. I've built multiple different businesses over the years, and so books around business like really excite me and I enjoy. What I'm reading right now, multiple different Lego books to my son. I haven't actually got a good read on. So I'm going to put this out to the community as well as to what should I read over the Christmas break. Which book should I get? What should I read? And what's going to help me take Amulet to the next step?
Great. All right, closing it off here. What's the best way to follow you and Amulet Protocol?
So best way is on Twitter. So at Amulet Protocol is our Twitter handle. If you want to follow me, it's at MetaBear with 4s instead of A's, because it makes it very easy that way. But if you follow at Amulet Protocol, you'll no doubt find me. But most importantly, go to amulet.org, join the community, join the Amu Nation, and and have some fun.
Thank you, Rupert, for being so generous with your time. We have been speaking with Rupert, the project lead of Amulet Protocol. If you enjoyed this conversation, be sure to check out on any of the previous episodes on Spotify and YouTube, and subscribe to our channel for all future episodes. We love your comments, feedback, and suggestions. You can write us at mondays@stakingrewards.com, sign up to a State of Stake newsletter at newsletter.stakingrewards.com, and follow me on Twitter. That's at Rokifehu, Rokifehu. See, I got the same problem there. Didn't think about it when putting up that name. And our team at Staking Rewards. I'm Marian Walter. You're listening to the Staking Mondays here on Staking Rewards. For Rupert and the audience, thanks for tuning in.
Thank you.